So, hi, welcome to Ab India Karega Invest, our Groww's initiative to reach out to all of you on a weekly basis with a new and interesting topic every week. This is Karthik here. Today, we are here with a very interesting topic on investing opportunities in mid-caps in the current market. That's the topic. To discuss on the topic, today we have Mr. Arun Sundaresan, who is the co-fund manager and also head product management at Nippon India Mutual Fund. So please welcome, sir. We are really looking forward for today's session.
Thank you.
The flow of the program is going to be, I will start the program. I'll just set the foundation for the basic and then subsequently hand it over to Mr. Arun to discuss on the topic in depth. And then we'll open the floor for question answers. Please post your questions. We would be very happy to answer as many questions as possible. Okay. Let me just share the screen. Talking about mid-caps as such, right? I think once in a while, it's always good to go back and visit the basics. So what I will do is I'll try to cover the basics of mid-caps, why it stands a better chance compared to large or small caps. Okay. And where is it poised? And if you look at the historical performance, how does it help you being part of your portfolio? So now, if you really look at mid-cap as a definition itself, I'm sure all thanks to recategorization of mutual fund schemes in 2018, SEBI defined mid-cap that all the companies ranked from 101 to 250 based on market capitalization have been categorized as mid-cap companies. So now, as a mid-cap index, if you see, this year has seen its own share of excitement, has already delivered close to 42% return so far. As of yesterday, it has generated 42% return. I think one of the most exciting times, a great bull run, what we have seen in the recent past. Most of the sectors, most of the stocks have gone through, like this bullish market phase. The question what we have in our mind right now is, okay, markets have already gone up. It's already upar gaya hai. Now, where is it headed to? What kind of sectors, what kind of stocks or funds we should have in a portfolio? How do we optimize it? I'm sure this is what we have what many of us would be thinking or what we have in mind. What we'll cover is from the mid-cap specific space. Where does mid-cap stands and then why mid-cap stands better? Okay. That's my share of the presentation. So when you look at the opportunity which is available in the mid-cap space, let's touch upon the fundamentals here. See, in general, like human beings, where we have different life stages, every company also go through its different stage. It could be in the early startup stage or the growth stage, then maturity and decline. When you look at the large cap companies, right, mostly you can categorize them under a stakeout or a maturity kind of a stage. And that's the stage where they've already grown big. The incremental revenue growth would be not so easy for large cap companies to produce. But that's the time their profits are also plateauing. So that's why a large cap companies would probably start struggling to really let's say, generate that incremental profit year on year or to see that kind of phenomenal growth, what is expected. But whereas mid-caps, probably they would be in that growth phase. They have that room or the headroom for them to grow. That's a generic statement. But if you look at the current market condition, what we see or what is expected from the post-COVID economic growth, right? The world is looking at China plus one kind of a manufacturing policy, or the current economic conditions which are actually conducive for manufacturing companies to grow and all that. This is actually helping or should ideally help not just large cap companies, but also mid cap companies in a substantial way. So that means expected from the mid cap space, but also all the challenges what we've seen in the last 4 or 5 years, be it with respect to demonetization or GST implementation and subsequently COVID impact. I think in the coming years, you talk to any expert, they all are very optimistic about the fact that in the coming years, we see that robust, unhindered economic growth. So that's one element, I'm sure, which all of us can agree to. Now, Now, for example, for a large cap company to really generate that extra return, or for a large cap fund to generate that alpha or beating the market itself, is a big challenge in there, right? Because the general understanding is markets are getting fairly efficient. The moment when we say markets are getting efficient, that means for an active fund manager, it's increasingly difficult to beat the underlying benchmark or to beat the expected rate of return. So this is what we call it as alpha. So when is that can happen? That can happen only when a large cap company comes out with a radical innovation, or all the flexibility which is possible to involve the technological innovation or what is changing in the industry. So that company again gets into a high growth phase, which is not very easy, right? I think without giving this as a recommendation, I think what Microsoft has done in the recent past could be considered as radical innovation. From a Windows only company to what they are today, to the multiple arena of services, I think they have shown the agility as a company to really accommodate for the changes so that they can grow perpetually in the near future. But that's not the case for every large cap space, right? So that's why I personally think there is a good amount of headroom available for mid caps to grow and outperform the large cap. But when it comes to the matter of small cap, right? If you go by the basic fundamental assumption, mid caps, most of the mid caps were simply large caps that have grown bigger in the past, right? And at the same time, since there is already some amount of growth, what they've already seen, the incremental growth from here should not be too difficult for them. It would act like a stepping stone, be it in terms of capital generation, capital raising, or let's say stepping the gas and then increasing the better market share, profitability, and all that should not be too difficult. So that means from large cap to small cap space, somewhere we can safely assume that mid caps generally are poised better in a general conditions as such itself. So it is not just what is expected, but even if you look at what has happened in the past as well, right? If you look at right from 2004 till 2021, that means as of September 2021, how large mid and small cap indices has performed. So I've taken BSE Sensex, BSE mid cap, and BSE small cap index here. One very interesting element to be noticed, or what you should ideally notice here, is the amount of volatility or the kind of returns what is generated from the large cap is fairly let's say consistent compared to small cap. So small cap, the volatility factor is significantly higher. So that means, which makes small cap investments, which is very highly seasonal. But when you mix these two, that is, when you look at these two in between, that is mid cap has, probably has given the best of both the worlds. The same graph could be explained in the next slide in a better way. So if you look at every bull market or a bear market, one interesting observation is during bullish bull markets, or when the markets have gone up, say maybe look at 2009, or maybe look at 2017 or 2021 for that matter, mid caps have outperformed the large cap in terms of the returns. So that's where it stands out. But at the same time, in terms of bearish markets, that means when the markets are going down, say maybe look at 2008 or 2013, mid caps have outperformed the small caps. So somewhere it is positioned or poised very well. So that's why I personally feel that mid caps as a category itself acts as a very well balancer for your portfolio. So I personally think mid cap as a category, it could be in the form of mid cap funds or mid cap stocks, could be part of your all season portfolio, or what we call it as core portfolio. So this is what I wanted to cover with respect to mid cap, and then a basic foundation about mid cap. To discuss further, I would like to call upon Mr. Arun to take it forward from here.
Thank you very much, Karthik. That was a very useful conceptual insight about broadly markets and very particularly mid caps. So I also have a few slides to share with the participants. Let me share my slides. So Karthik explained the concept part about mid caps. What I'll be doing for the next 20-25 minutes will be talk to you in a little bit of technical terms about market. So I've divided my presentation into three parts. One about the market outlook itself. Before we come to large cap or mid cap, what does the market itself entail? We'll be talking about that. Second, we'll be talking about what are the various lessons that markets, have been teaching us over a period of time. With very, very simple data points and facts. So that will be interesting. And the last part is we'll talk about this topic, the mid caps. What specifically holds good for mid cap at this point in time? How can you go about it? So that's how we're going to go about it. Mm, uh, Even though we're going to talk in technical terms, I'll try to make it as simple as possible and for the benefit of everyone, because we have a mixed audience here. Some of you could be very experienced, some of you could be relatively new. So I am aware of it. Therefore, we'll keep it very simple at the same time interesting for you the next 20-25 minutes. Uh, so obviously, today we are at the historic high. Every day is historic high now, 59,000 plus to the Sensex. So is the case with mid-cap index and various other indices. I just have three slides on markets. On markets, we can keep talking on and on, but I wanted to talk to you only about three major things which are very critical as far as markets are concerned. One is about globally what is happening. Second, very particularly about India, and three, about fund flows and sentiments. Where are they? Right now, look at this particular slide. Uh, the very important slide. I'll walk you through what this particular slide talks about. The left chart actually talks about how much the balance sheets of the group of four countries. That is, we are talking about US, Europe, the European Central Bank, Japan, Bank of Japan, and Bank of England. How much their balance sheets expanded in the recent times. Now, what do we mean by this balance sheet expansion? Why is it relevant? All of us know that March 2020, COVID hit the entire world. Everybody panicked, right? And so did the central governments and the central banks across the world. So naturally, when the economy was going through troubled times like this, you want to support the economy. How do you support? You pump in money. You literally buy bonds and you pump in money into the economy with the hope that this money will help revive the economy. People will be able to use that money to spend, and slowly things will start coming back. So this is the thought, and with that thought, only these four economies from March 2020, and given whatever they've committed, going forward, uh, they have pumped in nearly $13 trillion. I repeat, $13 trillion. That's the number that you are seeing in the left chart. Now, is this number small, big, very big? We'll have to put a context to the number. Just to compare, last time a major crisis that happened in the financial markets, all of us know that it's the global financial crisis that happened in 2008, right? At that time also, the central banks and the governments actually came in and did a lot of fiscal stimulus and support to the economy. But how much did they do at that point in time? They did $2.4 trillion. Now imagine during the global financial crisis time, it was $2.4 trillion. Now, around this time, in a matter of 1.5 years, we are talking about $13 trillion, which is almost 6 times. So you will have to imagine the amount of money that has gone into the economy. And naturally, when this much of money comes in, this huge liquidity obviously will find its way into different asset class, including equity, including commodity, including your cryptocurrencies and so on and so forth. That's precisely what has happened on hindsight. The fact I wanted to draw your attention to is that this amount of support is phenomenal, much, much more, much bigger than what we even saw during the last crisis of 2008. This is the chart to your left. This is on the fiscal support and how much money has been pumped into the system. The right chart actually talks about interest rate. So the central banks did not only put in money into the system, they also cut rates. They also cut interest rates very, very aggressively. In fact, in most developed economies, the interest rate, the real interest rate is now negative. This is the case even in India. All of you know that till about 2 years back, or about a one and a half, roughly about there, the repo rate itself was nearly about 6%. Today, our repo rate is 4%, but practically the operating rate, because when you keep so much money into the system, liquidity is so much into the system, banks tend to park that extra money with RBI at what we call as the reverse repo rate. So that reverse repo rate is 3.35%, which is practically the operating rate. So all your short-term rates, your FD rates for 1 year, 3 year, everything will take clue from the 3.35% rate, which is why you're seeing whether it is deposit rates, lending rates, all that have come down. They've crashed literally over the last 2 years. Now, how is it relevant for equity markets? Obviously, the cost of borrowing for companies comes down. So directly, it results in earnings. That's number one benefit. Second is that equity valuations, what we call as E multiple, also gets expanded. So it is very simply that even if your earnings has not grown, you're valuing that earnings. Now the interest rate is so low, to that extent, your equity valuation becomes that much more attractive, right? So these two are very, very phenomenal. These are not only global, this is applicable to India as well, both from a monetary support perspective in terms of interest rates being very low, as well as in terms of huge amount of money being available in the system and fiscal stimulus and support. It's the same in India, whether it is infrastructure spend, whether it is putting money in the hands of investors. It's been phenomenal. And the last part is that all these central banks have also committed to keeping this environment benign, friendly, growth friendly for a very, very long period of time. Even our own RBI has said that till such time growth comes back and it comes back equitably, they're going to keep this environment benign, despite even the fact that inflation is high. They're not really worried about inflation this time. They want growth to come back very, very solidly. So therefore, this is something that you need to keep in mind while you look at markets in isolation, 58,000, 59,000, 60,000, whatever. You will have to keep in mind the background in which the entire scenario has panned out. This is every time we say it's unprecedented, this is really, really unprecedented in terms of the quantum of money that has got pumped into the system. Therefore, what I'm trying to tell you is that the global outlook, because of this, obviously the virus has been largely contained, vaccination has picked up, a lot of places have opened up, things can only keep improving. So the global outlook, especially on the backdrop that the fiscal support, the monetary support has been very high, and it is likely to be very high going forward. Yes, at some point in time, I'm sure some of you were well read. There are talks about the support getting withdrawn. They talk about tapering happening, etc. But even in the last Fed meeting, the Fed chairman was very careful to articulate that yes, they will be slowing down on the bond purchase, meaning less and less money will be pumped into the economy. But that's not a sign as yet that interest rates will be increased. So that's actually a positive sign for equity. And given the state of affairs now, we think that these things will pan out very meaningfully over a period of time, and it will be carefully managed not to give any shock to the economy and to the markets. So at this point in time, this augurs very well as far as equity markets are concerned, both from a global perspective and it has a direct bearing on India. The second part that I wanted to talk to you, I am sorry, this is a very heavy slide. I don't expect you to read everything. Probably you can focus on the phase 5. So what we wanted to convey here is that, look, This COVID actually happened about 1.5 years back. March 20 is when COVID stuck, and since then we've had consumption and services sector led slowdown and all of that. But to be very sure, even prior to COVID, for a good almost 7 years, starting from 2012, 2013 onwards, India actually has been going through a slowdown. We've been going through a structural slowdown. We've been going through a capex-led slowdown. Now, I'll tell you the reasons. There are multiple reasons as to why we were going through that slowdown. First and foremost, the global scenario itself was not very healthy. For a good part, we had US-China trade war, commodity prices were flat, food prices across the world was flat. So all of these things, India, we had a real estate cycle, which was, kind of very, very flat for a very long period of time. So on one side, we had global headwinds. As far as India was concerned, we had our own set of problems. So prior to the global financial crisis in 2008, uh, before the last bull run, many of the companies across power, infrastructure, etc., they had put up huge plans. They had expanded big time. They created huge capacities. And once this crash came in 2008, the subsequent period started resulting in slowdown in activity across the board. So I mentioned to you commodity, real estate, for example. We saw that in multiple sectors. And at some point in time, this also started showing up as non-performing assets in the banking system. And later on in NBFC, all of you know that NBFC crisis happened, ILNFS crisis, and a whole lot of these things. So corporate India was literally struggling, and within that, specific segments also had problems. Like for example, pharma had various pricing related issues. It had FD related issues. All of these things were happening in pharma. Telecom was going through troubled times. So we're talking about a whole lot of real estate, banking, NBFC, pharma, telecom. So most of these sectors, and globally things were not good. IT was, not so great, and stuff like that, right? So first thing, globally things were bad. Corporate India was going through troubled times. And third, on top of it, our government was actually taking up tough reform measures, which may be good in the medium long term, but short term, it may have had some negative impact, like for example, demonetization, RERA, even GST, the cost of complaints. So all of these things were taking some time to settle down, and in the near term, it could have had a negative impact from a growth perspective. RBI on its side actually was more focused on inflation than growth, which is why about 2.5 years back, interest rates were actually quite high, whether repo rate or the entire focus of RBI was more towards inflation than growth. So this was the setting till about the virus hit. In a way, this has helped. It's kind of act as a trigger. So along with this 6 7 years slowdown, now we have faced another 1.5 years of consumption-led slowdown. Now everybody is pressing on the pedal for kind of accelerating growth. Now, from this kind of a scenario, things have completely turned around. As I said, the previous slide, I talked about the global scenario, which from having a lot of headwinds have now become, having a lot of tailwinds. A lot of things have got sorted. Number one, as far as corporate India is concerned, in a way, it's a self-correcting mechanism. So whether it's pharmaceuticals, telecom, banking, NPA, it's not an issue as much as it used to be. NBFC has come back, the cycle is back. Real estate has actually started doing very well. So corporate India, from how it used to be 3 4 years back, is now on firm footing. So that's the second aspect, second headwind that we talked about. Government on its part actually have started taking growth oriented reforms, right? For example, 2019 they took up this huge tax cut, the corporate tax rate cut, which made India Incorporated extremely competitive amongst the global companies. Now they've introduced PLI, which is the performance-linked incentive scheme for various sectors, whether it is pharma, API, or telecom, or sorry, manufacturing, or electronics. So all these companies are given incentive if they meet targets. In fact, they'll be given incentives, bringing down their cost overall. So all of these things are growth oriented. So RBI on its side also, and it is not just by their actions, even in terms of their articulation, they're very, very clear that they want to support growth. So they're doing all that is possible within their means to support growth. And despite the fact that inflation is high, they are willing to look through it. They're thinking of this as transitory, a temporary phenomena, and therefore they want to keep continuing on the growth path. Therefore, in a way, to us, it appears that this is a perfect alignment. Like, all your stars coming together globally, domestically, as well as from our government, RBI. All of these things are actually talking about getting aligned to growth. I think, we cannot have a better scenario than this. So therefore, in our assessment, the domestic outlook, in fact, we are coming through a slowdown after 6, 7 years of slowdown, and now things are poised for a sustained kind of a uptick growth for a very long period of time. So this is not going to be a flash in the pan. So this is not going to be only liquidity driven. That it's not just because it's market, and we do believe that we have a long way to go as far as a strong economic growth is concerned for a very long period of time. So even in RBI's own assessment, this year, we are likely to have 9.5% real GDP growth on the back of improving capacity utilization. In fact, today there is this interview by the RBI Deputy Governor, Mr. Patra. So he talks about this, that we expect growth to be very strong on the back of reviving manufacturing, improving capacity utilization, demand coming back, etc. So all these things should augur very well for the economy. Therefore, earnings growth to be stronger, which is a positive as far as equity market is concerned. My last slide on the market bit. This is on the flows, which is in a way indication of sentiment. So far we're talking about globally, fundamentally how things are, domestic markets how things are, both from a fundamental perspective, but along with fundamentals, sentiments are also important. Therefore, flows from both FPIs as well as domestic investors are important. Unfortunately, what had happened in the last year, starting from March 2020, was that domestic investors actually had been net redeemers. They'd been pulling out money from equity markets right from March 2020 onwards till March 2021. I repeat, right from March 2020 onwards till about this year, every month on month, in fact, the domestic investors were redeeming money from investments. So in fact, that got reflected as a mutual fund equity net sales, which was outflows month after month. FPI flows was very strong. In fact, for the calendar year of FY20, Jan till December 2020, FPIs actually pumped in nearly about $23 billion. Unfortunately, domestic investors, they had a sense of disbelief. Markets had crashed from 41,000 to 28,000. Then it started recovering. 28 became 32. And they thought, oh wow, this is a 20% high. COVID is still at the peak. This is good time. Market cannot go up. Let me redeem. 32 became 35. They redeemed. It eventually became 41, back to pre-COVID levels, peak levels. But COVID was still not behind us. They thought that this is good enough. Again redeemed. 43 new high, 45 new high, 47 new high. So they actually missed out on a good part of the rally that happened. But luckily, starting from March 2021, the flows have started becoming positive, the domestic flows, for 7 months now consecutively, March till August. We've seen inflows now coming in month after month, positive flows. So our sense is that this is a good indication of confidence coming back for investors, and it is also reflecting in a lot of data points. For example, a number of demat accounts. In fact, last year, nearly 1 crore plus demat account got opened, and you can see the chart here, right bottom, how the number of demat accounts. This is a show of appetite, response to IPOs, even the amount in bank current account and savings account. Normally, it will be about 4.5 lakh crores every year. That will be the incremental amount. Last year, it was nearly 10 lakh crores. So generally, Indian household savings is actually very strong. So it is estimated that we roughly have about 400 to 700 lakh crores, including real estate. It's a rough estimate, but we don't have so much of loans. This is not the scenario in Western countries. Western countries, loan tends to be a very high component of people's assets. But India, it's not the case. So therefore, it's a matter of confidence coming back. People have money once they feel confident, which seems to be the case of late. Along with FPA, this can also be a big positive as far as markets are concerned. So again, in our assessment, the sentiments seem to be in favor, and this is a strong momentum, which is also supporting markets. And unless something dramatic happens, something drastic happens, we don't see a big challenge, and hopefully things should carry on like this. So that concludes my part about the market. So net, what I wanted to convey to you is that uh, uh, don't look at market in isolation. Don't look at market levels and come to any conclusion, right? People were concluding all the time 35,000, 40,000, 45,000, 50,000, without understanding that I started my discussion saying that so much money, $13 trillion of money, which is 6 times more that we saw during the last financial crisis. That much money got pumped in. Uh, Interest rates are a historic low, even in India. The support from central banks continue to be towards growth. I talked to you about India, how we've actually gone through a fundamental structural slowdown, and we are poised for a turnaround. And now, slowly, people are realizing this, and we are seeing that interest coming back. Indian households are sitting on huge, wealth in which case, and the money that needs to come into capital markets, to equities, we have a long way to go. But we are seeing early signs of that coming into the market. I think all of these things bode well for equity markets in general. Now, very quickly, investment lessons. This part will be light. See, Sensex itself, right? It came into existence in 1979-80, almost 42 years, right? We're talking about 59,000 to the Sensex now. But the journey had not been smooth, right? So if you look at this chart, very quickly, maybe, I can ask this question to the audience later on. How many times you find a scam in this particular chart? Very quickly you can count that. And not just scam, a lot of political up and down, terrorist attack, a whole lot of things have happened in the market. Markets have gone up, down, reacted, but eventually it's produced the kind of returns it has over a period of time. Therefore, that's a way to look at equities in general, and of course, I'll come to mid caps, in a short while as well. So no one can be very sure as to what will happen when COVID. No one expected it will come in and it will impact markets. Equally, no one expected the kind of recovery. Today, we can give you commentaries, we can give you a lot of data on hindsight, but no one expected, right? And
if you try to time the market, you keep waiting for the best time to invest in markets. It may not be the right strategy to do. Rather, you'll have to take a directional call about market, where it's headed, or largely things in place, and then you'll have to take a leap of faith. That's how you make money, you create wealth in equities. Uh, so this is again some interesting data points. This is just Sensex, right? Where all of us keep talking about investing in equity markets for the longer term. And a lot of people sometimes sarcastically say, what do you mean by long term? And we generally say 3 years, 5 years, if not more. There is a reason why we say that. So if you look at this particular chart, the probability of losing return over the longer term keeps on coming down. In fact, over 3 years, the probability of losing return, this is on an average, right, has been 12%, which means that out of 220 trading days, maybe 20 days, if you had invested, and assuming that you invested only once, you've never spread your investments across, there is a chance that you could earn negative return over a period of 3 years. That's less than 10% chance, right? So in the long term, and as the more you invest, the longer you invest, the chances of making negative returns are very, very less. Which is why we recommend that please invest with a long-term horizon, regardless of the market conditions. I may give a very colorful view, but something might turn up, and you invest now for very long, 3 years, 5 years, returns may be negative. So that's part and parcel of investing. We need to embrace that in order to create wealth and equities. But this should give you some comfort that equities eventually, over the longer period of time, sometimes regardless of the fact that short-term returns could be impacted, tends to give you that return in the longer term. This is again for the timing bit. I talked to you some time back about the investor behavior, so I'm not going to talk much about it. Even at the end of March, right, midcaps had given 100% return. Then people thought, oh, this is 100% return. Now this is too much, and that's the same thing they did when midcaps had given 50% return earlier. Uh, and then this year from there on, it's again given 17% return. I'm talking about FY22. Karthik mentioned that for the entire calendar year it's given about 42%. So it's very difficult to time the market. Even today no one can be sure whether we will keep going up, or will have a correction and then go up, and what can be the journey. But that's why I said, more than trying to time the market, you need to take a directional call. Be clear about your goals in life, asset allocation, and then go about investing accordingly. Now, the last part about our presentation, the case for midcap. In fact, Karthik beautifully explained about the concept as to why theoretically midcaps have higher return. Also, the risk potential. Risk and return go hand in hand. So I'm not going to cover that, but very quickly, generally, mid-caps tend to do well. Within equities, mid-caps tend to do well whenever there is optimism. So whenever people are confident, particularly domestic investors, whenever they are confident, markets tend to become broad-based, right? Which is what we have seen historically also. For example, 2004 to 2007, we had a big bullish phase, right? Then we saw that again in 2014 was a good year. 2017 was a good year. So even if you take 2014 to 17 together, and now we have seen, from March till now, where for some part, it was slow, and after October particularly, it started becoming more broad-based, and people became much more confident, especially after the vaccination news started coming in. So whenever markets are overall looking positive, people are feeling optimistic and confident about market. Mid caps tend to do even better than large caps, right? So that is what we have portrayed in this particular slide, and they tend to outperform significantly during those phases. So if you are considering investing into mid cap, the question that you need to ask yourself is, first of all, is market bullish? If the answer is yes, probably mid caps. Are people feeling more confident about market? Is it likely to be, this way, or is it going to become patchy? Is it going to become very concerned? Are there going to be too many negatives? Is it going to be volatile? So in that kind of a scenario, mid caps could, kind of relatively underperform. It could trip down, right? So this is one way of looking at mid caps. The other way of looking at mid caps is that Karthik explained theoretically that over a longer period of time, mid caps have the tendency to outperform large caps, and they tend to do it significantly. If you believe that you have money for the longer term, it really does not matter whether mid caps are going to go through that volatility. There are going to be uncertain times. You go and invest into mid cap, it can be very well part of your core proposition. So as I said, there was a period, in fact, for a good period of 2018, 19, till about 2020, there was a lot of negativity in the market. Markets were narrow. Mid caps actually hugely outperformed. Therefore, when Sensex gave minus 4%, Nifty gave minus 8%, mid caps gave minus 33%. There's 25% underperformance, right? Now, once markets started turning around, particularly from June or you can say October, November onwards, they've kind of caught up, and now when Sensex are 70-75% during this time, they've given something like 100%. So this typically keeps on happening. There will be phases where different parts of the markets will keep performing differently, which is why I said that for you to, from a market a timing perspective, if you need to assess, but I need to look at large caps, mid caps, etc. A good starting point would be, am I feeling positive, bullish about the market? If you do, and at least the data seems to suggest by the flows and sentiments that a lot of people tend to believe, which is why the broader markets and mid caps and small caps are actually outperforming the large caps. So is it likely to continue? That is something that you can evaluate for yourself based on whatever I just presented. Now, one way of looking at market, always keep in mind this one, that everything, everything in life is a perspective. Even in markets, returns are a matter of perspectives, right? So you can always look at markets and say that look, last 1 year mid caps went up by 100%, and therefore they're very expensive. I'm scared, it's going to be taking a big correction and stuff like that. But let me give you a different perspective here. So what I'm showing you here is data from beginning of Jan 2015, right? That is after the bull run of 2014. 2014 was the bull run that we saw when BJP came into power with absolute majority, and there was a rally. There was a sharp rally, and after 2014, everybody expected that markets will keep going up and stuff like that, but it turned out to be the opposite way. 2015 and 2016 markets were flat. 2017 was a very good year. It went up, but then 2018 and 2019 again were very flat years, and for mid caps and small caps were even negative. 2020 there was a big crash, and again we've seen that up move, right? So during this entire period, 2015, starting from Jan 2015 till about 2021, we are talking about 6.5 years. During 6.5 years, Sensex has generated a CAGR of 11.7%, right? Midcap has generated a CAGR of 13.2%. This is after markets have touched 59,000. Right now, what am I trying to tell you here is that is 11.5%, 13% CAGR, a very high return. I leave that judgment to you. So basically, 6.5 years. This number is actually lower than our nominal GDP. Okay, so our nominal GDP for budget considerations itself will be closer to about 12-13%, right? So technically, markets over the last 6.5 years has actually underwhelmed a nominal GDP growth. Our GDP growth, economic growth itself has been lower than what our potential should be. for the various reasons I talked to you about, and markets have actually underwhelmed. Now, you can look at the bottle as half full or half empty. You can look at markets as saying that, it's gone up by 100%, it's expensive. Or you can, kind of widen your perspective and say that, look, 6.5 years, not gone anywhere. On the other hand, you have various other things that are happening, which are actually in favor of markets, and then, take calls accordingly. So you will have to not just look at things in isolation. You will have to look at the entire context, which is why we wanted to bring this webinar to you about how to view the market at this point in time. Now, talking about midcap fund, one of our funds, this is a phenomenal fund called as Nippon India Growth Fund. This was the first fund that we had launched in 1995. 10 rupee NAV in the fund is more than 2000 rupee NAV now, which means that 1 lakh rupee invested is more than 2 crores. And during the period of the last 26 years, this has grown at a CAGR of 22.67%. All this while I talk to you about markets, right? So in this case, market 1 lakh would have given you 20 lakh, okay, roughly. So this fund has given 10 times more, right? So this is not just a phenomenal fund. There are a lot of mutual funds which have done, equally, or some funds have done probably even better, right? There are a lot of examples. I think Groww can guide, or you can reach out to your financial advisors accordingly. But this is a quintessential example of what is possible. Again, past returns may not be repeated in the future, but it still gives you some idea. Again, like the same chart, last 20-25 years, several things have happened up and down, and so many things have happened, and this is the kind of returns. And during this period, the average 3-year return, any point in time you invested, on an average, the 3-year return has been something like 26%. So I think these things should give you confidence, but this should also not make you believe that money making is easy. You just need to invest, and so I mean it comes its own perils, up and down and volatility and stuff like that. And definitely the future returns may not be as attractive because the times are different. But my sense is that returns should still be reasonably good, decent in the context of overall economic growth and the market growth. My last slide, this is again a very interesting slide to tell you why discipline and why timing the market is not the best thing to do, right? So what this particular, again, I've taken example of this particular fund, not to promote a fund, but conceptually to tell you, how to view markets. So this is, we've taken SIP, Systematic Investment Plan. Many of you would be aware. If somebody had made an SIP of 10,000 rupees, let's say that they started in April 2019 and they kept on making till March 2020. So March 2020, they would have saved 1,20,000. Because markets fell so sharply at the end of March 2020, the investor would have lost his capital. It would have only been 91,000, and the scheme return at that point in time was minus 43% on a 1-year XARR basis. Okay, now even if somebody had made SIP for 5 years, 10,000 rupees, and for 5 years, you would have saved 6 lakh. That 6 lakh would have been 5,22,000, and the return would have been after 5 years 5.52% negative. Right now, investor would have been heartbroken, saying that you say long term, I invested long term, even after 5 years, this is negative, it's so horrible, what is this? And stuff like that. A lot of investors panicked, they redeemed money. That's the example I gave you, right? March, April, they kept on redeeming money. But the bottom chart, what it tells you is that had the investor continued for some more time, had he continued till April of 21, he would have saved 2,50,000. And when we did the valuation, this is as of 30th June, when we did this valuation, the 1-year return, which looked like minus 43% in March 2020, would have looked like 34% at that point in time. And a 5-year return would have been 15%, right? 10-year return would have been 15%. So the important thing to keep in mind is that obviously when you look at scheme returns at a point in time, right? In this case, this is an extreme when you're looking at market after markets have crashed. This also may be an extreme when you're looking at markets when it is at a historic peak. All these could be noise, and more importantly, if you're being disciplined, if you're not kind of got distracted with this noise and continued with your disciplined investments, you wouldn't have quit at the wrong time, and possibly you would have ended up earning reasonable returns had you stayed the course. So this is again a good way of looking at equity, good way of looking at mid caps. So my recommendation, my suggestion to you would be that if you have money today, this money is for the longer term. I don't need it for any specific purpose. It may be there for 3 years, 4 years, 5 years, doesn't matter. Go and invest in equities. Equities may go through that up and down. We don't know when that correction is going to come, right? So go and invest. Should I invest lump sum, SIP? Doesn't matter. If you have, let's say, 1 lakh, ideally you should invest lump sum now, or split it into 2 or 3 installments maximum. Don't dilute it. Don't thin it too fine. I'll invest 5,000 rupees and I'll do it for some 100 months, or don't go do all that. So spread it over a smaller period. On the other hand, if you're salaried employee, you have month on month salary coming to you. After your spending, you're able to save a bit. Keep saving. That is SIP for you. That should also work very well for you. I think that's the best way to go about it. While I gave a lot of yarn about markets, that's all useful. That's all good to know. But more importantly, how you approach investments. You're clear about your goals, how you want to go about it. I think that is what will be more critical, and that is what will make the difference end of the day. So with that, let me conclude. Obviously, mutual funds are subject to market risks. You need to read all scheme documents carefully. While I did, explain to you a lot of positive things about market, there are also a lot of risk factors. Not just now, at any point in time, there may be geopolitical tensions cropping up somewhere. There is always this talk that taper, where the US will start reducing the amount of money that is getting pumped into the system. At some point in time, they could increase interest rates. All these are negatives for the market. So, a lot of things can spoil the party, and, things can happen. So these risks are clear and present at any point in time. Nothing to take away any of these risks. You need to be mindful. But as I said, if you're clear about your goals and how you want to go about it, I think equity, you can make a good amount of money, and your objectives should be comfortably met. So with that, thank you very much for giving me this opportunity. Let me stop here and hand it over back to Karthik.
Thanks a lot, Arun. I think the very detailed perspective what you've given us, right from the global perspective, what to expect from the market, domestic perspective, and then what to expect from the mid-cap space. There are a few questions we would love to get your perspective. The first one being, I think, like you rightly pointed out, markets are touching new heights every day. What are some of the sectors one could keep in mind while investing, specifically mid-cap? What are some of the sectors? If not sounding like a recommendation, what's your thoughts on some sectors?
Generally, when you talk about market cap oriented funds like large cap or mid cap, they are diversified funds. So when we say diversified funds, by nature, they tend to invest across different sectors, be it IT, be it FMCG, oil, and as a strategy, all fund managers diversify across sectors. Yes, some fund managers could take a little more exposure in some sector, a little less in some sector, depending on the view from time to time. So if investors are choosing a fund like a mid-cap fund, and that's the topic that we are discussing, they really need not worry about which sector to choose and stuff like that. Having said that, as a fund house, we are positive on a few sectors, particularly those sectors which are more domestic oriented, which we think are more linked to the domestic economic growth than even the global. So when I say that, themes like banks itself, for example, they're supposed to be high beta. Some of the discretionary themes, it could be construction, it could be uh, selectively real estate. So some of those themes, we are relatively positive on. Slightly less on international themes like commodities, metals, which have probably already kind of run up heavily and stuff like that. So that's number two. In case somebody wants to invest into sector or very specific themes, which is why this question may be relevant. In that case, of course, there are various. We have a banking sector fund, we have a pharmaceutical, a power and infrastructure fund, there are IT funds. So they have various sectors to choose from. Generally, you will have defensive sectors like IT and pharma, right? And you will have aggressive sectors like banking, power, infrastructure, etc. So you need to choose. If you believe that markets are looking extremely good, they're looking very positive, then you choose high aggressive sectors like banking, power, and on the other hand, you want to play it safe and choose pharma, IT. So we belong to the camp of domestic sectors doing likely to catch up. The high beta sectors likely to do very well right now. So that's a relative thing. But diversified investors need not be worried. You're muted, Karthik.
Thanks, Arun. In fact, so the next question in the similar lines, see, I'm sure there's the general understanding that mid caps are riskier than large cap. So what are some of the points what an investor should keep in mind while investing in mid caps? And what's the investment horizon? Like, see, the general answer is link it to financial goals. But otherwise, what is the ideal horizon one should look at for investing in mid caps?
So, in your starting commentary, you beautifully explained the difference between large cap and mid caps. So it's very intuitive, right? So large caps are very well established companies. They already have lots of projects. They are on a cruise mode. So everything is well set, and the risk and return are in a way sorted. Mid caps, they can do very well. If they get it right, they can soar, or if they don't, they fall flat. So that's a theoretical kind of risk return, and that gets reflected in the stock price movements as well. So as I said, even a lot of data points are there to suggest that I did in my presentation point out that mid caps tend to do very well, especially during expansionary phase, especially during optimistic phase. They tend to outperform large caps. So one, if they want to tactically invest basis market condition, they can look at from that perspective mid caps. Today, if I believe that markets are looking this way, therefore probably I'll look at mid caps. That's one way of looking at it. The other way is I'm an youngster. I have probably 7, 8, 10 years more to go. I have nothing visible in the near term. So rather than investing within equity, going for rather defensives, let me go for an aggressive portfolio, and therefore let my portfolio be more mid cap and small cap oriented. That way there is no ideal time horizon for any market cap, or for that matter, any specific type of fund. But generally, as a rule, mid caps, relatively speaking, should be even more long term than even large caps. I would say, 3, 5 years, if not more.
Sure. So there's one interesting phenomenon. I'm sure you also pointed out there that the number of investors, the retail investors who have come in the recent past has been amazing. I think all these years in our presentation, we said that Indian retail investors are underrepresented in Indian markets. I think that has really changed today. A large segment of individual investors have come to markets. And there's also a very strong, belief that because of work from home, there's more investable surplus available in the hands of the people, right? I mean, people have shifted back to their hometown. They're not traveling. There's a good amount of savings which is happening. So it is expected to sustain for some more time. I mean, at least next 6 months, at least with larger IT firms and so on. So if this trend were to continue, would you see a sustainable bull run for a foreseeable time there?
Yeah. So first thing is this is also thanks to fintechs like Groww, done a phenomenal job in accelerating this phenomena. Having said that, in fact, today morning I was seeing a snippet which says that India, even now, out of the financial assets, right? Out of the financial assets, the capital market portion is only 7%,
Okay.
right? So emerging markets, I'm not even talking about developed market. Emerging markets, this number is 30%.
Okay.
So first of all, India financial assets itself is lower. It's largely fiscal assets, real estate and gold. In fact, one of the charts I showed that, right? It's only 5%, right? Within that, the capital market assets is very small, right? So we have a long way to go. It's a good beginning and the direction. And I sincerely hope that it progresses very rapidly. But we have a long way to go. And obviously, if this happens and continues to happen, it will be a big tailwind and support to the market. It will help, the depth of the market. It will help stabilize the market. So it will augur very well for the equity markets.
So next question, I'm not sure how much you can comment on it. So since in general, there is a bullish sentiment in the market amongst the fund houses and equity market experts and so on. So we also understand that equity and gold prices are negatively correlated. So from that point of view, do you see in the near future, is gold may not be a great investment option from that angle?
No, I completely agree with you. That assessment is a fair assessment. Generally, gold is seen as a safe haven asset, and whenever there is uncertainty and negativity, gold tends to do well. Today, that's not the case, right? So everything looks positive, which is what has resulted in gold not doing well as well, right? But then, having said that, regardless of the view at this point in time, right? It makes a lot of sense to have 10 or a 15% gold as part of your investment as asset allocation. In fact, we've gone through a lot of studies. It's there in World Gold Council also. A 10 or a 15% gold as part of the asset allocation adds tremendous value to your overall portfolio, both in terms of returns as well as in terms of risk-adjusted returns, diversification, etc. In fact, gold. Interestingly, last 10 years, the last decade, gold has been the best asset class. In fact, it did well in, I think, 5 out of the 10 years. Gold was the best asset class. You never know, when it does well, it does hugely. So I would say that rather than take a market view-based approach to gold from an investment perspective, at any point in time, investors should consider having 10 to 15% towards gold.
Yeah, I think from asset allocation point of view, I think it makes a lot of sense. I don't think then you need to worry about timing the market itself.
Yes.
But one final question, Arun. Are we in a bubble? If yes, then is I don't know to what extent one can answer to this question. The next correction, which might come, is it going to come at one shot like what we saw in 2008 or 2020 March, or is it going to come in pockets? What's your take?
See, generally when people talk about bubble, they talk about valuations. They talk about in the context of valuations being very high, right? Now, let's not make any mistake about it. Valuations are indeed very high, okay, by various measures. So for example, I'll tell you market cap to GDP, right? Market cap to GDP for India today is about 110%, 111% kind of number. And then, if you plot historically where we have been and then see that it's very high, same is the case with P, whether it is forward P or trailing P, all of that will give you an impression that when compared to historic numbers, we are at a very high level, which gives an impression that we are at a bubble, which is why we need to look at the context in which this is happening, right? Now, I'll give you again a different perspective. Now, before the global financial crisis, the same market cap to GDP number in India was 149%. So that was the highest number that we had seen. So when compared to 149%, today we are at 111%. At the same time, when compared to 2.4 trillion dollars which got pumped in at that point in time, we now have $13 trillion. So when compared to interest rates, then we are today at historically much lower interest rates, right? So all of these things will have to be seen together, which is why I said generally, especially retail investors tend to make this mistake of looking at a few numbers in isolation. Like for example, at least P is still okay, but if you start looking at Sensex in isolation, saying that 59,000 or 60,000, right? We will not head anywhere. Where is this 59, 60 now? Why has this come through? Because you have so much money, you have liquidity, and interest rate is so low, and therefore we are. So you need to keep that in mind. And from that perspective, our personal assessment is that we are not anywhere in that kind of a zone. Correction, can it happen? It can happen anytime, right? See, who thought after the bull run that we saw in 2014 after Modi ji came into power that things will be so bad. Next 2 years turned out to be bad. 2015-16, and on 2016, on top of everything, demonetization happened. Then we thought this is going to be the end of it. Then came 2017, which was the best bull run that we saw. Month on month, markets went up. SIP inflows are so good. Then we thought that it was invincible, nothing can go wrong. 2018-19 were bad years. So COVID was a good example. March 2020, we thought it was the end of the world. It looked completely hopeless, and then markets recovered. So it's very difficult to time both ways. How much it's going to go up, or whether it's a bubble, and how much correction, when, and all that. So rather than focusing our energies there, my recommendation to our viewers would be to, like you said, to focus on, they need to be clear, right? See, suppose I have 10 lakhs with me. It really doesn't matter if market is going to take a correction, it's going to last for 1 year or 2 years. I have 10 lakhs. I don't need this money for 3 or 5 years. I close my eyes, invest in mid caps. Choose a reasonably good mutual fund and sort it.
So can I say that as an individual investor, let me not worry about what's going to happen to the market. I'll give it to you guys as experts. You do the job. My job is to save the money and invest at the right place. Can we conclude at that?
In a way, see, mutual fund managers are no magicians. So if you give money to us as a mid cap, we're going to deploy in the market, right? So we are going to be subject to all market risks. So we're not going to protect you from something. And, all I'm saying is that, as long as you're clear about how you want to go, like, you have your money, it's meant for the longer term. You don't really have to be getting confused. What is happening here? Broadly, you need to know, yes, which is what, all these things. Today, most of these things are looking reasonably good, and, that should be fine. That's how I would look at it. I will never deploy my money. So suppose I have a specific requirement after 1 year. Suppose I'm buying a property for which I need to make a payment, right? 1 year down the line. I'll never invest into equity, regardless of whether the market outlook is extremely good or no. No, I will not take that risk. So I think that's a better way to go. It's good to know about markets, what is happening and stuff like that. But all said and done, the more important thing is to, as I said, to be clear about why we are doing what we are doing.
Great. So thanks a lot, Arun, for your time. We really got a lot of fresh insights into the concept of mid cap, and then how should we look at it. So thank you so much, and thanks everyone for being part of it. Have a great weekend ahead. Thank you.
Thank you very much.